Hello and welcome to Know Your Debt Fund. I'm Sumaira Abdi, and with me this afternoon is Harshvardhan Roongta, Roongta Securities, and together we're going to explore a category of debt mutual funds which is almost never in the limelight: short duration funds. Now, short duration funds is a 92,000 crore rupee category which is spread across 27 funds currently. Now that the Franklin short-term fund has been wound down, but more than 50% of the total assets under management are controlled by the top 5 schemes in this category. The short duration funds are defined by the average maturity of the underlying assets which they invest in, which should be about 1 to 3 years. Now, do remember that at the moment there is no regulatory distinction to be made on what should be the credit quality of these investments, just that they should mature between 1 to 3 years. Now, just to clarify on this point, let me also highlight the portfolio construct of the Franklin India short-term income plan which shut down. Overall, the fund had made over 100 individual investments, but only 6 of them were rated AAA. So how do you evaluate the short duration fund in your portfolio? Harshvardhan, good afternoon, and thanks very much for joining in. So my first question to you is just that: if somebody has heard the news of the Franklin short-term fund being wound down and they have a short duration fund in their portfolio, how do they evaluate it, since there is no compulsion on whether that scheme should be investing in AA, AAA, single A, even below? What should they look for, and are there schemes currently which are taking as much risk as Franklin did? Harsh, can you hear me?
Yes, I can hear you now. I can hear you, sir. Now I can hear you, Sumaira.
Okay. If we talk about the short duration funds, there is no compulsion currently on what they can invest in. It doesn't have to be AAA if you were to go just by the regulatory definition, and which is what perhaps Franklin exploited, and for a while it worked for them. So are there any other funds which are primarily moving away from AAA? How do people assess a short duration bond fund that they may be holding?
Well, Sumaira, you're right. What the regulator has clearly mandated is the macular duration that each category of funds need to follow. So you will have a short-term fund with a clear mandate to have a macular duration of between 1 year to 3 years. Now, if there is an investor who has parked his money into a short-term fund and wants to really understand as to what is the risk that the fund is taking, so we've got 4 top funds in this category from in terms of the AUM, and we just have a little deeper look into these funds. You will get to know through their portfolio fact sheets. I mean, it's not a very difficult thing to do. A retail investor, a layman, can also simply go into those fact sheets to see what is the percentage holding of AAA, AA, etc. If you were to just take the top 4 in terms of AUM, which control almost 50% of the market, if you look at the IDFC short-term bond fund, it has 100% holding only in AAA rated funds. So very clearly, the fund is very clear in their objective, saying that we will always create a portfolio of only AAA rated. Our average maturity of the paper will be about 2.31 years. That is what currently it is. And if you look at the scheme YTM, and why am I referring to this particular comparison, so that the viewers can get an idea as to what happens if there is a incremental risk in the form of a AA rated paper. So what is the effect on the scheme YTM? So if you look at the IDFC, which is a AAA rated portfolio, the scheme YTM is about 6.52. Now, the second in the category, if you're picking up, is ICICI short-term fund. It has primarily a AAA and a sovereign papers holding in their portfolio, with a 20% exposure into AA. Now, this AA is also, primarily focused with the Tata Group and the Bharti Airtel. So I don't think in that sense there is a lot of cause of concern, but there is a AA exposure to the extent of 20% of the portfolio. Now, if you look at the scheme YTM, you see an increment of almost about 100 basis points whereas compared to IDFC. So where IDFC had 6.52 as a scheme YTM, you will have about 7.51 in case of ICICI. Now, if you look at HDFC short term, which is also amongst the top 4 in terms of AUM, they have a AA exposure of about 14% in their portfolio. So primarily in AAA and sovereign rated bonds, but with a 14% exposure into double A. Now the scheme YTM in that sense is about 7.48, and an SBI short-term fund which has a double A exposure of 9% in their portfolio, and the scheme YTM is 6.73. So, Sumera, the essence which an investor should keep in mind, in case you're looking at a scenario where you want some bit of incremental returns, then even say probably a risk-free portfolio in that sense, then you will have to take incremental exposure. Now, where the fund management skills come into picture is if you can take that incremental risk in a very calculated and careful manner. So, in that sense, I pointed out to you the ICICI short-term fund has 20% exposure, but the exposure is also with the Tata Group, primarily with Tata Group and the Airtel Group. Now, which is, in my opinion, a reasonably fair risk to take in this category, because Tatas don't even have a record of default ever in the history of the economics that we've seen. Tatas don't have a history of default at all. So if an investor is comfortable with this kind of an exposure, then he can look at 100 basis points higher return in that sense from his investment. So this is just to give a fair idea to an investor that if you're getting incremental returns, does not mean that everything is same as a AAA portfolio and then still you're getting higher return. There has to be some difference, and that is the difference that we've shown right now. Now, if you look at the Franklin episode that happened, you will see that the portfolio primarily consisted of only AA, A and below. Now, if that is the case, and that is why they were able to give you a 200 basis points higher return all throughout in the past, which attracted a lot of investors.
All right, so the operative part is that risk-adjusted returns, for schemes have to be seen. If you're comfortable to take a little more risk and, you can earn that little bit more return, but there are schemes available that are very, very prudent as well. Harsh, what purpose actually does a short-term or a short-duration bond fund serve in somebody's portfolio? Is it just to keep money aside for some goal which has to be fulfilled, and so you want to just keep earning a little bit on it, or should it be an active portion of somebody's portfolio?
Well, Sumera, if you see what SEBI has done in the year 2017, they've come out with different categories. So if you just look at the first 6 categories, the starting in ascending order, look at the first one, which is an overnight fund. The mandate is that you will invest only in one-day papers. Then you have a liquid fund, which is a 91-day holding period. Then you have an ultra short term, which is 3 months to 6 months. Then you have a low duration and money market, which have a mandate to invest with a maculate duration of about 1 year. Now, short term comes 6th in the list, which is from 1 year to 3 years. Now, while the first 5 categories, the ones that we talked about is the overnight, the liquid, ultra short, low duration, money market, these essentially are liquidity management schemes. So in the sense, if I am an investor, I don't really have an objective of making money out of this. It's that I don't need money for a couple of months. I don't know how long, but I need to park it away and I will need it in a short while. So my objective is liquidity management. So I park my money into these overnight, liquid, ultra short term, low duration, etc. I park my money into these schemes wherein I want money at call, I want it immediately, and that's my requirement. So it's liquidity management. But however, me as an investor also has an asset allocation plan in place, which means that my long-term goals, I have equity and debt. That is what we've been advocating to all investors, that you should have a prudent mix of equity and debt in your portfolio. Now, within the debt space, when it comes to asset allocation, now I'm talking about serious investments. There, I will explore public provident fund, I will explore, government bonds, etc., and debt mutual funds. Now, in that category of my investments, for that need of mine, I will pick a short-term fund. Now, even if I don't need money for 10 years, say suppose I have in mind that I can stay invested for 10 years at a time, I can still park my money into short-term funds because it has a macular duration of between 1 to 3 years, but it's an open-ended ongoing fund. So the scheme today may have an average maturity of say 2.5 to 3 years. But the papers continuously keep rolling over, and I can be invested into these schemes and also at the same time get a little better advantage in terms of a return which is slightly higher, or at least has the potential to give me higher returns than my fixed deposits. It is far more tax efficient for me. It is easy to invest and redeem. I mean, I can do it online. There is no impact of TDS on this. So this becomes a little more convenient option for me with the potential to earn a higher return than what a traditional bank fixed deposit would give. So from a layman investor's point of view, if you have an asset allocation requirement, you do not need to go into a liquid fund. You do not need to go in for a long-term fund. You can stick to this category of short-term funds, and it works beautifully for an investor who's looking to preserve capital, at the same time have a quality portfolio such as a AAA or a maximum say about a 15-20% of AA in their portfolio, so that you get slightly better returns or a potential for a higher return than a traditional fixed deposit.
All right, so fair enough. And you'd say that, by and large, the greater number of, schemes in this category are, investing into safer instruments, right?
Yes, so I'm talking about just the top biggest right now, and the learning out of this fiasco that has happened recently with Franklin. I'm sure all fund houses have now realized that they cannot take a chance and they cannot take investors for a ride under the pretext that we wish to get a higher return, and let's just put any kind of paper in this. So in fact, in this category itself, if you're looking, so we're talking about a return, a scheme YTM of about 7.5 to 6.5 to 7.5%. But the actual realized returns, because interest rates have softened, the actual realized return of the top schemes has been around 9.5 to 10%. Now, what is also important to notice is that not all schemes have given you this kind of return, which is 9.5 to 10% in the last 1 year. And why is that? That is something that when you go into the details, you will realize that not all the schemes that we're talking about have invested only into AAA or AA. They have seen defaults even in this category, with the likes of holding DHFL and ILFS, etc.
All right, so there is, credit risk that exists over here because, you're right. If I can ask my director to actually pull up the bottom two plates on this, you'll see that there are, at least 7-8 schemes that are giving negative returns, and some of them are pretty substantial, from 3 to 4%. And there's a BOI AXA short-term fund which has actually given a 1-year return that's negative 20%. Harsh, what explains this? Is it just that papers went bad and therefore valuations had to be cut accordingly?
Yes, of course. So as I said, if a Franklin Ultra Short Fund could have credit risk in it, there is nothing that stops even a short-term fund manager to invest into low-rated papers. And that's exactly what happened with these schemes that you're looking at, which have a negative return. So all these schemes which have a negative return have been somewhere impacted by one of the defaults that you've seen. Either it could be DHFL, it could be ILNFS, it could be any other such paper which has been included in the portfolio and now has been marked down or written off. So these underperformances are a clear message that not all funds in this category, there could be about 27 to 28 funds, if I'm not mistaken, in this entire category. Not everybody has a clear investment philosophy. So as an investor, it is important that you check with the fund house which you're investing with. Like, I can talk about IDFC for sure, because they have a very clear mandate that they will at all times, and that's not from today, they have been managing this for almost 10 years, and that's what their investment philosophy has been, that they will only invest into AAA rated papers with an average maturity of about 2.3 years. If that is the mandate, as an investor, you get that comfort. ICICI, for that matter, also is very clear that even if they're taking exposure into AA rated papers, it is going to be from good corporates. So that incremental risk is also very calculated risk. So I'm giving you two examples. One is a AAA rated, 100% AAA rated portfolio. So if an investor is very clear in his mind that I want slightly better than fixed deposits, I want a tax efficient investment, and it is a part of my asset allocation into debt, then you have IDFC. If you're willing to take some bit of incremental calculated risk to get 100 basis points more, then you have ICICI, which has a 20% exposure. The other two top in the category, as I mentioned, is HDFC and SBI. So you have these. And then if you're looking at anything beyond this, make sure that your investment philosophy aligns with that of the fund manager. You cannot have a fund manager taking exponential risk with low rated papers and your objective being to safeguard and preserve your capital.
All right, we'll take a break on that note. It's pretty clear that, whatever category you want to invest in, you have to slice across the portfolio and see what is it that you're investing in and what is the comfort level that you have with the person who's going to be managing that money. We'll take a very quick break. We'll come right back, and on the other side, we'll tell you exactly where you can find all of this information and whether it matters or not. What is the size of the fund that you're investing in? I mean, what sort of weightage should that give to your decision? All of that is lined up next. Welcome back to Know Your Debt Fund. With me is Harshvardhan Roongta of Roongta Securities, and we've been talking about the short duration funds from the debt fund category today. Well, we've spoken a bit about how to understand whether or not you need a debt fund, what are their peculiarities, what to look for, and there is a query that has come in, so let me just pull that up for you. Nimish has written to me on Twitter, and he wants to know that he has a fund that's a UTI short-term income fund. It has only AAA paper, and he wants to know what to do with it. I mean, we pulled up the one-year performance, and you'd see that UTI short-term had given a one-year negative 3% return. Harsh?
Well, Sumera, now UTI is one of the examples that we were speaking about. Currently, it owns only AAA and sovereign papers with just about a 7.5% exposure into a single A paper of just one Punjab National Bank. Other than this, the entire portfolio is AAA or sovereign. Now the question arises, despite this, how have they given 1 year return of a negative 3.5%? It's because they had DHFL invested into in the last 1 year, which has been completely marked down. The paper still continues to be a part of the portfolio, but it is showing as a valuation of 0 right now. So that is why you've seen an impact of negative 3% in the last 1 year. But going further, of course, they have a AAA rated portfolio. So in that sense, there is no harm. A point of concern here is the AUM, which you also raised before we went on to the break. How important is the entire the size of AUM? Now, in this case, if you see, UTI holds a total of 36 securities in their portfolio, and the AUM is about 1,500 crores. Now, what is important in terms of diversification also, if you have many now, a lot of securities. So if you talk about the top 4 that we spoke about, the IDFC, ICICI, HDFC and SBI, they hold securities of up to about 100 securities or more than that. So the risk is diversified across different companies, different sectors and different issuers altogether. So my suggestion is, when you're investing, look at diversification also, look at the portfolio constituents which are AAA, sovereign, etc. Also the number of securities that the portfolio holds. So my suggestion to Nimish is that though the portfolio is AAA rated, I think considering the number of securities that it holds and the AUM, I think you should move out and invest into one of the top 4 that we've already highlighted.
Okay, Harsh, let's just go back to the Franklin example for a moment over here. If you see the maturity profile, you'd see that there are a lot of papers which are maturing, for even longer than 5 years. And therefore, how does it fulfill the mandate of maturing between 1 to 3 years?
So, well, Sumera, all of these schemes are open-ended and continuous schemes. So it's not a FMP kind of a situation wherein you will invest today and you know that if it's maturing in 36 months, you will have all papers with a maturity of 36 months. These are continuous schemes and investors keep coming into it and going out of it. And because the macular duration is mandated to be between 1 and 3 years, you have to see the average maturity of all these papers. So the macular duration actually gives you that kind of a sense that that's the weighted average of the cash flows that the bondholders will receive over a period of time. So I think a macular duration is a good indicator, and we should give that point of benefit of doubt to the fund manager to say that they could also hold some papers which are 5 years, some could be even as early as 3 months from now, as long as the macular duration is within the regulatory guidelines, which is 1 to 3 years.
All right, Harsh, thanks very much for joining in and for explaining the concept of the short duration bond fund. And just as we wrap up, I want to leave the viewers with a 1 year, monthly flows chart of money moving in and out of the short duration bond fund category, just to show that there could be some bit of smart money also in this category, and therefore do be alert to the movements that take place. Thanks very much for watching Know Your Debt Fund. Closing bell comes up next.